Imagine the 48th floor of JP Morgan's Madison Avenue Tower. A single call cuts through the trading floor. We need $4 billion. Now, for years, that sentence was just background noise. But today, the line goes quiet. The wire never comes. What I am about to reveal is the most dangerous phase of the silver endgame, that moment the crisis moves from the commodities exchange directly into your personal savings. In the next 20 minutes, we are going inside a dramatized crash course of the bail-in blueprint. We will expose, first, the $75 billion fire hose the Fed used to patch holes in the overnight repo market at year-end 2025, with ongoing stresses carrying into early 2026. Second, how silver's critical role in national defense has elevated it to a national security event amid supply vulnerabilities. Third, Iran's recent claims of testing an ICBM with a 10,000 kilometers range, paired with heightened military alerts, turning global logistics into an uninsurable risk. And finally, I will show you how to move your wealth outside the digital grid before the resolution machinery freezes your access. If you think your bank balance is a stack of cash with your name on it, you are in for a brutal awakening. Let's go inside. The unthinkable is now the base case. The largest bullion bank on the planet has missed a margin requirement. Technically, they are in default. To understand why a bank with trillions in assets would choke on $4 billion Australian dollars call, you have to understand that assets and cash are not the same thing. Their balance sheet is stuffed with long-dated bonds, gutted by interest rates and office real estate nobody wants. They are solvent on paper but starved for actual transferable dollars. As silver rockets higher, hitting a record $117.69 per ounce just days ago, and trading around $113 today, up over 270% year-over-year amid safe haven demand and supply deficits. JP Morgan's short book is being torched. When trust vanishes, the overnight repo market, where banks lend to each other, starts flashing red. On December 31, 2025, the Fed had to push a record $75 billion into this market, an eightfold increase in just days as year-end liquidity turmoil spiked rates and forced banks to borrow heavily from the standing repo facility. This signals that major institutions were in danger of failing the test, with the balance dropping back to near zero by early January 2026. But underlying pressures persisting as silver's surge continues. Silver is not a fringe metal. It is posted as collateral behind an estimated $200 to $250 billion in derivative exposure in the U.S. banking system alone. Recent reports and social media discussions highlight banks holding massive net short positions, around 212 million ounces in COMEX futures, with OTC exposure likely far larger. As prices climb, margin requirements have jumped up to 50%, requiring $25,000 to $32,500 per contract, amplifying the risk of a short squeeze. When that collateral fails, the entire plumbing of the financial system begins to leak. This isn't isolated. It's echoed in warnings from former executives about silver lease rates exploding to 9 to 10% and London OTC markets falling into backwardation extending 5 years out, signaling mounting structural stress heading into 2026. The math is brutal. Global annual silver mining is around 800 million ounces, yet banks are reportedly short up to 4.4 billion ounces in combined positions. If silver sustains above $100, $150, derivative losses could escalate rapidly, potentially forcing liquidations or central bank interventions. This setup recalls past squeezes like the 1980 Hunt Brothers episode, where prices spiked from $6 to $50 before crashing. But today's deficits, over 820 million ounces cumulatively since 2021, and depleted vaults make it far more precarious. Physical premiums are already diverging, indicating the paper market is breaking from real-world supply realities. This is where it hits home. Under the post-2008 resolution playbook, a failing megabank isn't always bailed out. It is bailed in from the inside. Legally, your bank balance isn't your money. It is an unsecured loan you made to the bank. You are an unsecured creditor. If the bank collapses under its silver shorts, the legal machinery can convert your certain claims into equity. To recapitalize the institution, imagine logging into your retirement portal and seeing a warning banner. Account access temporarily restricted due to ongoing resolution proceedings. You thought you were nowhere near the casino, but your life savings were sitting on the same table. This is why the modern twist of money is so dangerous. Every transaction is trackable, every account is programmable, and access is conditional. Transitions like this don't happen during stability. They happen during chaos, when people are exhausted and desperate for order. Look at historical precedents. In Cyprus 2013, depositors over 100,000 euros lost up to 47.5% in bail-ins to rescue failing banks. In Argentina's 2001 Corralito, savings were frozen, converted to bonds, and devalued, wiping out generations of wealth. Today, with digital currencies and programmable money on the horizon, controls are even tighter. Central banks are testing CBDCs that could expire funds or restrict usage, amplifying risks in a crisis. Silver's role exacerbates this as a critical industrial metal for solar, EVs, AI chips, and defense. Its shortage, fueled by China's new export licensing starting January 1, 2026, limiting shipments to just 44 approved companies, creates global friction. This blockade effect reduces Western access to refined silver, estimated at 121 million ounces annually from China alone, widening the deficit. Projected at 230 million ounces for 2025, banks' short positions become untenable, triggering cascading failures. Social media is buzzing with warnings. Markets in London, New York, and Shanghai are on the verge of freezing, with 100% margin calls looming on silver and related metals. If banks face a silver time bomb, your deposits could be the collateral they seize. The quiet buildup of Basel III rules requiring physical backing for paper positions adds pressure, shifting risks to European institutions and hedge funds. Preparation means diversifying now before access restrictions turn intentions into regrets. While the banks are failing, the world is watching the wrong thing. Iran recently claimed to have tested an ICBM with a range of 10,000 kilometers, capable of reaching the U.S. East Coast, fired toward the Sea of Siberia with Russian approval. Geography no longer protects the Western world. This is paired with heightened military alerts, including emergency orders, recalling senior commanders on high readiness, signaling a level right before war, issued only when a strike is deemed imminent. Projections show Iran could field up to 60 ICBMs by 2035, escalating long-range threats. When missiles fly, global shipping becomes uninsurable. Silver, which is essential for every guidance system, satellite, and radar array, stops moving. Defense assessments confirm that strategic silver stockpiles are at vulnerable levels, not seen since the mid-20th century, with ongoing industrial demand straining supplies. Under Section 232 authority, once a material is deemed critical to national defense, the government can override markets, restrict civilian access, and procure metal at any price. This elevates silver to a national security imperative beyond mere finance. Your only defense is to move into physical metal in hand, something that exists without an internet connection and doesn't need a bank's permission. Target your survival stack of 50 to 100 ounces. This baseline shifts you from exposed to protected, allowing you to weather volatility. Silver stays asleep for long stretches, then it wakes up violently, as seen in this 2026 surge driven by geopolitics, trade tensions like Trump's tariffs, and green energy demands. If you can't touch it, you don't own it. The quiet window where you can think clearly is getting smaller by the hour. Stay vigilant, stay disciplined. I will see you in the next intelligence briefing.